Well, welcome to the program again, Michael. It's great to have you back.
Hi, Simon. How are you?
Very well, thank you. Surviving?
Yeah, that's about it at the moment, I think.
Absolutely. Maybe we could start with sort of any updates. What's been happening from a central bank's perspective, and is there any update there?
There's been a few things. The US central bank, the Fed, came out during the week, and one of the things they commented on was the fact they're not necessarily going to be targeting the yield curve in their sort of quantitative easing or monetary policy settings. So we have seen the 10-year US bonds rise a little bit. So they were trading down at about 0.5% about a month ago, and they're just above 0.65%, still incredibly low. But that the other night also saw a bit of a rebound in the US dollar, which has been weakening quite a lot. So there's that. The RBA sort of minutes have come out. No great surprises there, but there is a bit of I guess a discrepancy or difference between what the RBA are doing versus the RBNZ. So in New Zealand, they're not ruling out negative interest rates, and they've been commenting a little bit on the strength of the New Zealand dollar, whereas the RBA are really, if not ruling out negative interest rates, making it clear that they would really be a last resort. It's not their favoured approach. And they're saying the Aussie dollar, whilst they'd like it lower, is not really at a level that's not justified by current fundamentals. So we've seen quite a sharp move up in the Aussie Kiwi. It's traded above 1.1 for the first time in 2018. So you're starting to see different central banks maybe having slightly different things that they're looking at or targeting, or some of their communications are varying a little bit. So yeah, they're certainly continuing to have an impact on markets. Yeah, the RBA have also forecast unemployment in Australia to be around 10% later this year, and they're saying that it's only very gradually going to fall back towards 7% over the next year or two. So yeah, there's certainly been a little bit in the central bank space.
So has that really affected the currency side of things then?
Well, certainly the Aussie Kiwi, it certainly helped when the RBNZ came out last week, and versus what the RBA was saying. We have seen an overall theme of a weakening US dollar anyway. So I guess and I to be honest, I think the US Fed Reserve would be quite comfortable with the US dollar weakening, and certainly I think they are pretty comfortable with that. Also, there is, depending on how much weight you put on this, is the US dollar potentially part of the global trade war, or the trade war with China, and some of the I guess the declining geopolitical concerns there, where the US dollar can be quite a target in a few ways. It's the reserve currency, so access to US dollars you can target, or the US can target, to make life a lot more difficult. But also, if the US dollar weakens, that certainly can be quite effective as well. So yeah, there's certainly stuff happening in the FX markets, but some of it's obviously fundamental driven, and some of it's most probably more central bank driven.
Absolutely. And what about on the bond side of things?
Well, as I mentioned, certainly we saw the US bond yields have risen a little bit from about 0.5 to 0.65%. That's the 10-year bond in the last month. And part of that's been, I guess, some data has been a little bit more positive. So we've seen that. We've seen as we mentioned, the US Fed sort of not specifically targeting the longer part of the yield curve. So that's also seen yields rise a little bit. In Australia, though, they've actually come off a little bit. So we're currently around 0.85%, our 10-year bond. I think this time last month when we spoke, we were just above 0.9. So not a lot, but that differential has narrowed a little bit. between Australia and the US, but funnily enough, that hasn't hurt the Aussie US. It's certainly the Aussie US is marginally higher.
And what about on the commodity side?
In fact, the Aussie traded at its highs for the year, 72, sort of 65 earlier in the week. Commodities, again, some interesting moves there. We've clearly seen gold make a record high. So it traded up to, I think, US 2,075 an ounce. I think that was around the 7th of August. It has retraced, so it's back just under 1,950. But that gold's been interesting because it's up about 27% for the year. And clearly gold is, well, traditionally it was seen as a hedge against inflation. Well, there's certainly no inflation at the moment. And a safe haven sort of asset and flight to quality. And it's certainly been a beneficiary of that. But then we could talk a bit about equities in a minute, but you've got record highs in US equities. So clearly equities are seen as not necessarily seen as a safe haven asset. They're more a risk sort of appetite or risk on asset. So yeah, it's been interesting to see a sort of safe haven asset and equities, so gold and equities both at sort of all-time highs together. So I guess it just adds to some of the nuances we've seen in 2020. If you look at oil, that clearly seems a long time since that fell into negative territory. And I think the West Texas is sort of hovering around the $42 a barrel mark. It's still 30% below its where it was at the start of the year, but it's a long way above its lows, even, you know, ignoring the brief period it went into negative territory. I guess with oil, it's really going to depend on, you know, things like international travel, which doesn't look like resuming anytime soon, and trade. There's still a question mark, I think, as supply chains potentially may become more localised over time, and trade wars and other geopolitical influences. So I think oil, to me, is most probably going to struggle to rally significantly. But having said that, if there are signs of global economic upturns, and or we find a vaccine and COVID becomes a thing of the past, which I think's a fair way away, but clearly that would be very supportive for oil. I guess iron ore continues, and that's been one of the reasons the Aussie's been so strong. It's traded up to around, or the futures around $120 a tonne. I think most people this time sort of last year or coming into this year were most probably forecasting closer to sort of $65 or thereabouts. That's been obviously increased stimulus and demand from China and supply challenges from Brazil, who are one of the major other exporters of iron ore. But I think over time markets are expecting iron ore prices to ease and additional supply potentially come on board. They're most probably the main sort of drivers. We're seeing some, you know, in food commodities, there's quite a lot of movement around at the moment. Markets in some of the food commodities may be bottoming, and we have seen a bit of a rally in some of those. But yeah, the main ones, I guess, in the news have been most probably iron ore and gold.
Yep. And what about for the treasurers out there? What are we keeping our eyes on in the coming month?
Well, I think as we've spoken about, we continue to look at the economic data and try and interpret it. So if you look at, say, in Australia recently, you know, some good examples are the unemployment data. We're sitting at the moment around 7.5%, the official figures, but of course the true figure may be around 11% or somewhere there. It's hard to interpret the participation rates all over the place, and there's a lot of government stimulus that's potentially distorting it. I think with unemployment, people need to look at that we've never returned to our pre-GFC lows of the low 4% level, and it's going to be many years, I think, till we get towards 5%, which is where we were sort of pre-COVID. So I think I think the second lockdown in Victoria is significant. If you looked at the last Westpac consumer sentiment numbers, they fell by 9.5%, and in fact, New South Wales fell by 15.5%. So nearly double the fall in Victoria. Remember, Sydney and Melbourne account for roughly 43% of Australia's GDP. So any COVID-related things, particularly in Melbourne and Sydney, people should take notice on. I think for treasurers or people, it's largely somewhat going to depend on your sector. Like if you look at the latest business confidence numbers, sector by sector, there's quite some wild swings going on. So, recreation, hospitality had a bit of an upturn, but now with these additional sort of lockdowns in Melbourne, and if something, let's hope that doesn't happen in Sydney, different sectors are going to get impacted. So I think for treasurers, trying to decipher the data, ever changing, and try and see through some of the distortions is a challenge, because that does impact things like currencies, maybe longer dated bond yields. I think the geopolitical side is something that we need to continue, in my opinion, to watch. So we've got a US election coming up in now less than 100 days, assuming it goes ahead and people can vote by post or however they're going to do it. So that's sort of now well and truly on the radar. The Australia-China trade continues, to be challenged, and the wine industry is the latest one there to sort of come up against some challenges. And I guess the US-China situation. So I think the US might have been in the last day or two said they're suspending extradition treaty with Hong Kong and ending reciprocal tax treatments, even though they're meant to be, sitting down to assess the progress of the phase 1 US-China trade deal. So I think geopolitical things are actually quite significant, and I think for treasurers, they can impact markets. So I'd be paying attention to that. I think if you're a borrower, again, I think the short end of the curve should stay pretty flat, around 25 basis points out to 3 years, and the RBA will continue to support that. I'd be watching the longer end of the curve to see where the RBA aren't really targeting so much, to see what happens there. So I'd be paying most probably more attention maybe than normal to the 10-year part of the curve. And in the currency, I think just keep an eye out for what the central banks are saying and doing, and watch the geopolitical side, and for the Aussie dollar, most probably our trade, which has been incredibly strong, and another reason why the Aussie's where it is. I think most people are thinking the Aussie at the end of the year will be comfortably above 70 cents, and certainly I think Westpac and NAB at the end of next year are in the high to mid 70s, or even up as high as 80 cents. So I think the Aussie looks reasonably positive, but again, if something further happens to global growth, or there's changes in central bank policies or geopolitical events, that could weigh against it. So they're most probably the key things.
Super, Michael. Well, thank you very much once again. Always love your insights, and I look forward to chatting next month.
Okay, thank you.